The first thing, probably the topic that people were most interested in, from what I could see, was structured dividend capture.
Mhm.
So there was just a few follow-up questions there, Matt. You did kind of answer this already, but I'll ask it to you again. With the structured dividend capture approach, there is still the risk that the shares drop by a significant amount in the week that we are waiting for the option to expire. Can you really compare it to a cash position?
That is a fine question. There is some risk that a given share could. So we have a basket of these securities, and the probability of any one of these securities falling. These are not terrible businesses. They are sustainable businesses, generally with growing earnings and cash flows. So there is potential for market fluctuation or a macro fluctuation. But typically, we're able to really get in and out of these very quickly, and we're picking up premiums along the entire way. So, as I mentioned, if a 10% drop is a large drop in a security, but if we're able to pick up 5% as something's taking a large drop, we're able to maintain a pretty consistent cash level. So we haven't seen this majorly impact things. And I think if you look at the back testing graph, we do have some longer versions where we show there are some quarterly dips, but it is in and out, it is highly liquid. We are in and out of cash very quickly, and typically our cash pool is growing. And if we over a short period of time experience a 5 or 7 or 10% decline in the cash, it comes back very quickly. This is a very good long-term strategy to have in place, and allows us to keep, but it truly is cash. I mean, we are allocating our cash into this position, and over the course of a couple of quarters, we expect to be getting teens returns on our cash.
So it sounds as though you can't obviously rule that stuff out, but it's the strategy is to consistently do it and do it across a basket of opportunities and keep doing it, and the averages kind of work themselves out.
That's right. So if you go through the individual, we call it the max track internally. If you go through the maximum capital flow that we presented, you could have an individual security that falls quite considerably. But unless the entire market drops, which does happen, unless the entire market drops, we will have a diversified basket of these holdings. And we usually are involved in, say, 4 to 10 at a given time. So an individual security won't have an outsized impact. If one security falls or even half of them fall, we usually are still breaking even or even making money. It's when the market declines as a whole that we could be down a little bit. But again, we're protected against the total market collapse, as I explained.
Right. There was a follow-up question on that, which you've kind of started touching on. That the example that you showed was across a 10-year period where the US market was doing very well overall. Do you have any examples of perhaps 2020? How would that strategy fare when there are losses in the S&P or there's a big market downturn?
Yeah, so that's a great question, and it's common. Internally, we are constantly trying to get more data. In fact, Nadiv spent weeks and weeks this summer just trying to clean up the data that we had. And we have gone over extended periods. 25 years allows us to capture things back into the 90s. But what happens is we're missing so much data that we end up replacing it, and then it becomes we're a little less confident in the final result. So what we've shown here, we're very confident, but of course, we understand this is during a bull market. So when we look at 2020, we do see that we experienced decline during those times. So March 2020, the entire market comes down. We just don't fall quite as much, and we are comfortable with that. By the way, as the shares come down, it's worth noting we sell a call, and if we don't sell out of the position, we can go and sell another call. So in a way, instead of getting 3 payments coming in, we ultimately receive 4 or 5. We're also patient in sort of letting these positions breathe. So if something dropped significantly, we would look at the business a little bit and say, is this really temporary? Maybe we can just wait for another week and we can get out at a more attractive price. So we do see that in the instances where the entire market is coming down, we do see a decline. It's just not as significant as the market. And over time, this is adding considerably to our portfolio. And by the way, this has only been in practice for about 2 years. So we expect this to help accelerate some of the future returns.
Another question on structured dividend capture was the back testing seems quite promising. How has it performed over the last 12 months that has been implemented into the fund? And is the risk return profile still worth it with 1 to 3 month T-bills above 5% right now?
Yeah, that's a very interesting question. So, as interest rates go up, we start to earn a more attractive rate on our cash, but we have to trust the data and the analysis. So we don't expect this to be extremely consistent throughout the year, but over a couple of quarters, we do expect that this return is going to be fairly accurate. So of course, if we're able to extract sort of teens return and maybe very attractive teens returns from the market, the opportunity cost of not doing it and earning just 5% would cost us, 8 or 13% to the cash holding of our fund. And the cash in our fund, as value fund managers, we often have many millions in cash. We could have 20 or 30% of our portfolio in cash. And so now we have a strategy where we can put this cash to work, continue getting gains out of this cash, and be really comfortable holding on for the long term. So this is quite attractive. We're monitoring it very closely. We're working on back testing. We're actually modeling out all sorts of different scenarios now. We're trying to really fine-tune this and enhance in a very structured, non-emotional, unbiased way. We're trying to get almost a recipe that we just simply follow, and it delivers over time these nice returns.
What would the returns for the fund look like after taxes?
Okay, great question. So when we do the structured dividend capture, these are unfortunately treated as short-term capital gains. So unless you have money in a qualified account, a lot of you have funds with us, assets from IRAs and other qualified. Those, of course, are not taxed. They maintain their beneficial tax treatment. However, on cash, this flows through as short-term capital gains, and you'll be taxed. It just comes through the K-1s. Any tax liability will come through at a short-term capital gains rate. For some and many LPs, that may be higher than they would like. When folks get into the 40 or 50% range, it is high. However, we're not going to leave this money on the ground when it's available just because we have to pay taxes. So for us, we look at this as a very nice way to just reach in for a moment and grab a dividend. A lot of times we're talking about this over a 2-week period, but technically we might own the shares for just 5 days. And during that process, we're picking up dividends and premiums. So this is taxed higher than we like. The infinite compounders are the ideal tax scenario. They keep growing. There is no taxable events. It is completely untaxed until we liquidate a holding. But unfortunately, on this, if we're returning 15% and somebody is taxed at 30% plus, they may have to pay a little bit of that in taxes. And if it's onerous to anybody, you can always redeem a little bit to pay your taxes. Although keep in mind, if we have a 20% position in the fund, if we earn 20% on that, it's just 4%. If you're in the 50% tax bracket, it's 2%. The amount of taxes relative to the balance of an account is pretty low. So hopefully it isn't too difficult for anybody to come.
Okay, cool. One question we had around structured dividend capture, what's the limit on this strategy? Why not put the whole fund in it?
Yeah. Some people would argue we should. Look, the limit is, so we've evaluated, the limit's actually very important. Institutional capital cannot participate in this profitably. There just simply isn't the bandwidth. But there are a lot of securities we can look at, as I mentioned, 40 to 50 per quarter that our analysis is revealing to us, that our technology is providing to us. in each of these, many of these are multi-billion-dollar firms. So we can easily put $1 million or $2 million into these over a short period of time. So with that, we look at it as a small piece of our overall portfolio, and we might be able to allocate 50 million into this particular situation, which should mean that we can operate this way with a $250 million fund without any issue. The problem is that most institutional capital is sitting on many billions. And so this won't move the needle for them. And fortunately for us, they don't participate in this space at all. I actually brought the original structured value practice to Goldman over 15 years ago, ran a little analysis, saw what we could do, and it wasn't of interest. It wouldn't move the needle. We determined we would make about 30 or 40 million a year, and that just wasn't worth making the investment from an institutional banking perspective. But for a small, nimble fund like us, for individual investors like many of you, it is extremely attractive. It's extremely lucrative. As many of you know, you're doing this kind of thing individually. Many participants in the fund have assets in the fund and then are also practicing with this, enjoying this process and making a lot of money. So this gives us an opportunity. Institutional capital stays away. Most retail investors have nowhere near the level of sophistication or the capability to execute on this. We derived this entire strategy ourselves. We have proposed many different theories and proven that they wouldn't work. What we finally found is one that does work. And so we're sharing this with you. We probably will not talk about it forever because we don't want everybody in the world to know what we're doing and start copying us and eroding the opportunity. But we're in early days, so we're happy to share with you what we've discovered. It's very attractive and lucrative.
Probably last question on this topic, getting a little bit deeper into the weeds. How do you go about calculating the strike price, and do we sell the call exactly on the expiry date or the ex-dividend date?
Yeah, great questions. Now you want to know what we've really uncovered. So we are building out a number of back tests that are evaluating what happens if we sell strikes in the money versus out of the money, what happens if we change the day that we're selling these contracts. So what we want to do is totally eliminate any human decision, any subjectivity out of the process. And by doing that, we believe that we'll be able to take that 18% yield, back test on further data, and maybe get that to grow a little bit more. So I will share with you what we've found so far and the way that we execute, although we may enhance this. What we do right now is when we're looking at an opportunity, we sell a contract that expires one strike out of the money. So if the shares are trading for $99.50, we will sell a 99 strike put. This means that it requires the shares to dip just below 99 for us to actually get the shares and the dividend. And then we turn around and we sell a call one strike out of the money. So we're constantly selling one strike out of the money on the puts and one strike out of the money on the calls. And then if we, for some reason, don't exit, we can sell a repeated call. The other question about the timing of when we write these, it's interesting to note that these puts and calls can be executed prior to expiration, but the purchaser has paid a time value. So typically they hold till expiration to find out the true outcome of the contract before they make their decision. But certain purchasers of the contract, maybe they get a margin call, maybe something goes on in their own situation, they can put the shares to us early. If there is a large dividend, so when we get the shares, we know when the dividend date is, we know the date of record, we know when we can have the strike price pending for an existing sale. We don't actually need to wait for the dividend to be, for the ex-dividend date or for the dividend to be paid. However, if we sell with a strike too far in the money, the counterpart will execute that contract. They will take the shares from us prior to the ex-dividend date, which means they will take the dividend. So when we get the shares, we are often selling, we're actually writing contracts on the weekend. So we're putting in all our orders where the markets are closed. So on a Saturday or Sunday, we will look at what shares were put to us and when those ex-dividend dates are and when we can arrange strike prices, and we will write them, but we will write them out of the money. And we will write them with a price that's above the current market price. So we will let the volatility get us a better IRR on our return. And over a day or two, quite often, then somebody will purchase those shares, and maybe the ex-dividend date hasn't passed yet. So what happens is, if the shares were to climb above the strike price significantly, those shares could get pulled away from us. But because we've put the strike price above the current market price, we're actually earning a very nice return regardless. So we will write the contracts prior to the ex-dividend date occurring, but our hope is that we keep the shares, get the dividend, receive the call premium and receive the put premium, and exit on a very cleanly.
Okay, cool. Thank you very much. I think they are all the questions that we had around structured dividend capture. Was obviously a very popular topic. One topic that I wanted to bring up now, because I don't think you touched on it during your prepared remarks, a couple of questions around Daily Journal. This question here says, I would love an update on Daily Journal. We saw a large increase in revenues after a long period of stasis just a couple of days ago. Matthew, when do you expect the Australia contracts to come online? What do you think of the new CEO? Thank you.
Okay, great. It's worth pointing out there is a commitment and consistency bias. So you'll see many funds that refuse to talk about their existing positions. You'll also see oftentimes, if there's low volume or if we're talking to a really large audience, we'll be reluctant because it will perhaps cause the price to move slightly and maybe we're buying. And I bring this up because we've actually inverted the equation a little bit. The commitment and consistency bias basically says if you talk publicly, you're committing yourself to your thesis and you discount disconfirming evidence, and you find it much more difficult to move away from the position. However, these are truly infinite compounders. We want to be holding these for a very long period of time, decades, if we can. And so we're okay with committing ourselves to this, subjecting ourselves to this commitment and consistency bias. So without going into an enormous amount of detail, I can touch on Daily Journal a little bit. First of all, Stephen Myhill-Jones and I had a call, I guess, probably 24 months now. He's a really outstanding choice. He was brought to Charlie Munger by the guys at the Tiny Funds. I think some of you know those folks, and we're really pleased because what we understand now is that had Stephen not been available, Charlie had to find an alternative. He wasn't sure who was going to run the firm, and he was even exploring options for a total sale, which would have been a problem because we would have lost the potential upside. So Stephen ran software solutions, government software solution in Canada for a lot of years. Those of you who are reading through these annual reports will see that they just opened up Daily Journal Canada. So that's a very exciting development. And we are really pleased. He is a perfect candidate. He is young. He is experienced. He has already achieved great success. And he has this opportunity to work with not only Charlie Munger, but the 300 people that have been hand-selected by Charlie Munger and Rick Guerin and all these incredible folks for decades. So Stephen's very pleased with his role. He's happy to be there for a very long period of time. We want him to stay for a long period of time. I think he's a great addition to the firm. I'm very pleased with the work that he's doing. So regarding some of the other, Daily Journal is remarkable. Daily Journal is an incredible business. It's a SaaS business. So people thought it was a newspaper business for years. I think we probably internally, we know this business better than I think anybody on the planet outside of the company, probably better than most people inside the company. And we brought a lot of the information out. So nobody really knew what Daily Journal was doing, but Charlie Munger was referring to this software solution. And what they're doing is they're creating a software solution for courthouses all around the world. This becomes 10-year government contracts, very large contracts. They've built out a solution. They've brought in they've made some purchases to create the larger entity. And they're going through a lot of changes and to bring this up to speed. So they have one main competitor, Tyler Technologies, and Daily Journal is basically the other player in this oligopoly. And courthouses are notoriously behind in terms of their uses of technology. So the solution is very much in demand, and it actually saves the courthouses and counties money, which is really attractive. So they come in and actually the IRR is very positive for using a daily journal. The question was, one piece of the question was about this jump in revenues, which I've sort of been talking about a little bit over the last couple of years. It's fascinating to me to see. It's difficult for, I think, a lot of people to pay this much attention, but Daily Journal originally had two software solutions. They had Justware and they had eSuites. And Justware was something that they acquired because eSuites in the 90s was not catching on quite as well as they had liked. eSuites was their premier service, browser-based, cloud-based solution. What they needed was a Justware solution that already had hundreds of customers. And over the course of about a decade, they really merged these two businesses. So they had Justware as sort of the premier entry-level solution, and then they had Justware as the entry-level solution, and then they had their premier eSuites. And during the pandemic, it was a little shocking. We actually were pleased. I don't know if it was handled perfectly, but there was a memo that went out to all clients of Daily Journal that said we are no longer going to be supporting the Justware solution. We are going to move exclusively to eSuites, and we look forward to integrating this new software. So what that meant was that out of a really low revenue base, and out of the low revenue base of, let's call it at the time, 30 million, they were eliminating 8 million from the balance sheet. And they did it across fiscal years. So when that occurred, it removed about 2 million from the financial statements in 2021. Then it removed 8 million in 2022. And then that 8 million continues. But what happened was it stayed flat. What most of the world missed is, why did it stay flat? It stayed flat because eSuites is growing so rapidly. So as eSuites is rapidly growing, it looked like it stayed flat for a couple of years. And I mentioned 3 years ago, people are going to miss this. They're going to think revenue's not growing. But now we see revenue from eSuites exploding upward. We have, I believe, 45 million in annual revenue coming now into Daily Journal. About 4 years ago, from a very small start, we were modeling out 100 million in revenues by 2030. And to put that in perspective, it is remarkable that this company run by the management team is so talented. The capital allocation skills are so profound. And this is a company that has a 400 million market cap. They have 315 or so in equity. They have some deferred capital gains, a small liability, some margin loans, et cetera. And when we remove all liabilities from the company against the equity portfolio, we still have a net assets of 200 million within the 400 million market cap, leaving just 200 million as the total cost for the newspaper business, which we often put at zero, and the software business, which is growing and has 45 million revenue. So we do anticipate they will reach this number, and it will grow far beyond this number. So 100 million in 2030 is our previous projection. That is just a line in the sand. They could exceed that number. That should put this Daily Journal business at a valuation of $1 billion or so. Tyler Technologies, their main competitor, is selling for like 15 times revenue. So Daily Journal is earning 45 billion. Without their equity portfolio, it just costs, or 45 million without their equity portfolio, it costs just $200 million to have a firm that has been built by Charlie Munger over 40 years. They have a Charlie Munger run equity portfolio. They have all the moats in place for an outstanding business. They are doing things in a very unique way. And I will add one isolated comment, which is that being daily journal owner makes us better investors, because I am watching very carefully what Charlie is doing, what Howard Marks' partners doing, what all of these exceptional individuals on the board are doing, and we're implementing those strategies into our own business. Sometimes it takes us a while to even understand what they're doing. Charlie Munger has commented on this. We can't teach the new dogs the old tricks. So we're constantly evaluating Daily Journal, trying to figure out what are the old tricks. And when we discover them, they're like gems, and then we incorporate them into our own processes.
Awesome. Thank you very much for that update. That also covered the other question we got on Daily Journal. I'm going to move along. We've got two more topics to cover, one of them being Alibaba. We did have a few questions around Alibaba. The first one here is, would you be open to disclose whether you hold Baba through ADRs instead of 9988 in Hong Kong? Wondering if there are any risks holding ADRs versus on the SDHK.
Yeah, I think we do own the ADRs, and in fact, because it's early, we have like short puts on those ADRs, and we're monitoring the development closely. Our view is that there is a risk of this delisting. Our view is that the probability of the Chinese Communist Party causing destruction to their capital markets by ripping investments out of foreign holders' hands is actually very unlikely. It's a nice narrative. It's unlikely, but we watch it carefully. So if, in fact, I have personal accounts where we do testing, I lose money in my personal accounts to test things before we put it into the fund. We are actively using some option contracts around DD just to see what will happen if there is a delisting. And so we are watching carefully. I think we will see it very early. And fortunately, because we use structured value, we get a nice premium when we exit. And so hopefully we see things early. If that were to transpire, we would exit or try to revert the shares over. But this is very common. People debate this a lot. Is it safe to hold the ADRs of a Chinese company? What happens if there's political conflict, et cetera? Our view, and I think a common view among very sophisticated people, is that it would be very disruptive to the capital markets. China is very well aware that they need the capital markets to persist, to continue their advance. And because of that, we do not think that they're going to disrupt the ADR channel. We believe that they will try to fit the US regulations, maybe negotiate. There might be some threatening times, but in many regards, that's what's giving us this great entry point right now.
I wanted to talk a little bit more about Alibaba and the puts that you're selling. The question is, since Alibaba is spinning off parts of the company, does selling Baba puts years out put you at risk of missing out on the spin-offs? So how far out of the expiry? Scott adds, this is what I was thinking. Maybe you only use a portion of your cash to sell puts and still have a large existing position. Having long-dated option defeats the purpose of having cash since it ties up your liquidity. Ryan notes, yeah, it would be interesting to know how this fits into a tranching strategy.
Yeah, that's a very insightful question. In fact, I'll try to discuss it two ways. We'll talk about it in terms of Baba, and then some of the things that could happen with Seritage. So these corporate events, a large corporate event, similar to an unplanned dividend, the CBOE makes a ruling, and that ruling there are consistent rulings that take place. So if a firm divests a big business line, you actually either are rewarded by having a drop in the strike price of the contracts that you've sold, or you will have a non-standard option affiliated with that new position. So as these corporate events take place, we expect to actually maintain our position, maintain all of our exposure. We need to see on an individual basis what the CBOE does for these scenarios. So there is a risk that the CBOE could treat things incorrectly, but it's pretty low. They're a well-established entity. Although we do have times where we disagree with how they're treating certain scenarios, but realistically, we expect to receive the full value. When they spin out Cloud, what we will receive is short puts on the new Cloud entity. We will receive non-standard puts, or if if as that spin out occurs, there's just a market value, but no option contracts, no non-standard option contracts, the CBOE will come in and they will reduce the strike price we've committed to pay for BABA based on the value of the shares that they've removed from their holding. So in the same way, if there's a special dividend, they do the exact same thing. If a company comes in and announces that they're going to pay out a 10% special dividend, the amount per share that's received will be reflected as an absolute amount drop in the strike price of those contracts. The reason this is important is that one thing people miss with Seritage, one thing that is very attractive for us and could still be attractive in the future and may be attractive for many of you, is that $9.20 they're going to pay out, those are not standard dividends. Those are going to be distributions. What that means to me is that the CBOE will make rulings each time they distribute capital and the strike price will decline. So if we can be confident, for example, that there's going to be $5 distributed from Seritage, and we are very, very comfortable with that number, we can also be extremely comfortable selling a $5 put and picking up the premium, because each time that they distribute $1 to the shareholders, that strike price is going to go down. And at the end, the strike price will be zero and a share is not going to sell below zero. And so we will never buy the stock. So we're just collecting free premium. Now, because it's a melting ice cube, we would rather do this with a growing business than a shrinking business, but some of you may still find this attractive. Seritage has some interesting things going on, but in both these scenarios, it all comes down to how the CBOE handles the divestitures that are taking place, how they handle special dividends, how they handle all of these corporate announcements. A lot of the situation going on within BABA, even though they are going to act as catalysts, they're basically going to signal to the market what the real value is. But BABA, the entity, may continue holding their shares of something that they IPO. They may IPO something, but continue maintaining their position. There's just now an external market price for that position, which is why it will act as a catalyst. So we won't always be losing what they're doing in their IPO. They can maintain their 30% position and go and IPO something like Fresh Hippo and just keep the rest of it on the books. And then internally, BABA will determine should they be selling those shares, which would then turn it to cash, but we would still own that cash, or should they maintain that position for future growth? And then we would be involved in, for example, the Fresh Hippo IPO.
Okay, cool. Thanks, Matt. We have about 10 minutes left, so I'm going to move on. We've got one more topic that was asked about a lot, and that was, of course, the structured value. So the first, we've got 4 questions. I'm hoping we can get through all 4, so might be a bit of a speed round. We'll see how we go. Regarding the structured value approach to buying into positions, how has the fund determined the best put contract durations and strike prices to maximize value across the 4 simplified outcomes that Matt outlined?
Wonderful. A lot of what we're explaining here is stated in a plain vanilla way. We have a really diverse audience. And so these are, in some cases, they're very real, but they're also plain vanilla. What we are really doing, because we have a larger pool of capital, we don't need to sell just one contract. We are building out a matrix. So we will sell contracts that have different strike prices. We will also sell contracts that have different expiration dates. Because of that, as we move through time, we typically find that we purchase some of the shares underlying the contracts that we've written, and others are above the strike price at expiration, and we don't buy those. What that does is it kind of further lowers our cost basis. It also allows us to sort of cost average in over time. So if we have contracts that are expiring every month for the next 12 months, generically, if there's a price of 10 and the price is oscillating around there, we're buying during the great opportunities and we're not buying when the shares are at 12, and we're keeping all of the premium. So what we do is we create a matrix, we figure out our total notional exposure that we'd like to have in that position, and we write out those contracts. And then incidentally, as those contracts expire, we then evaluate whether we took on the exposure or not, and we write further contracts. So we keep writing contracts until we get our full notional exposure. And it's quite attractive. I mean, if a price is volatile and flat, we actually do quite well, really bringing down the costs. I'm seeing some of these questions in the chat, so I'll just comment on it. Someone asked about, is it really possible to pick up $25 premiums on a $100 share? And shockingly, it's possible. It happens. It's not available every day. You have to be patient. But when there's a pandemic, when there's a flash crash, when an individual security, because this is not just market volatility, but an individual security declines into our buy zone, the volatility that's affiliated, directly correlated with the price of these contracts rises considerably. So at the same time that a price comes down to our buy zone, the option contracts grow substantially. And so I gave the real example of BABA. You can all go and do this. It's not a 25% return in 12 months. It's about a 30% return in 24 months. It's not terrible. It's truly quite incredible. And as mentioned, if you consider the underlying business, that's what, most people using these contracts are using them for entirely different purposes. We've inverted the entire thing. Everybody's using a put to just buy it and protect their portfolio. Some institutions are forced to do it, like a life insurance organization that would have an equity portfolio might be forced to buy puts all the time to protect their portfolio and pay out claims. So these are typically used for entirely different purposes. And with a situation like BABA, where they have a portfolio and they have cash, and we're already reducing with our buy price of 70, we're already reducing the cost to about 175 billion for this incredible business. The cost of these operations are now down to $100 billion. So it's just remarkable. I hesitate to say this because I don't want to encourage people to be too active in there with options. But what we have learned something over many years, and that is there are certain cases where the asymmetry in the underlier is so great that we need to do a little something extra because we don't want to miss the opportunity. And I will tell you, we are doing that with BABA. So in addition to selling these puts, we can take a small amount of the premium and we can use it to buy. I like to buy in the money call options because then we aren't quite as dependent on some price in the future, but we actually lock in our current price. We're actually looking at it as a way to build in free call options to our portfolio. So we're selling puts, sometimes even shorter than the 2-year period that I mentioned. We can sell shorter term puts and pick that up and then purchase some in the money long-term calls and lock in a BABA buy at a price far below 90 years from now.
Okay, cool. I've got just a couple more questions. If you're holding your stocks long term, are you not fully invested? If you're selling cash secured puts a year out, then that cash is tied up for 1 year. So what percentage of the portfolio is normally in cash?
Yeah, good question. So of course, when we move into our infinite compounders, and most of these have been developing over years, that becomes an investment, that becomes an equity holding. But we are currently, we have a 20 million plus portfolio, and we have about 3 million that's sitting around in cash, between 3 and 4 million. And so that's a really healthy number. Now that we have the structured dividend capture process going, it's quite attractive because historically, if we were to take in a large check, say a $5 million check comes in, that can be a weight on the portfolio for existing LPs if it's just sitting around earning nothing. But we now put that to work immediately. So the observation from this question is quite correct. We hold the collateral and the cash to purchase the securities. So we do end up with quite a bit of cash. But that excess cash, we are now taking some of that cash and we are using it for short-term periods to just reach in and grab a dividend from a firm like eBay, a firm like Oracle, a firm like US Bank. These firms will exist in 10 years. We are safely going in and just capturing a dividend over a very short period of time with that cash that we hold. So we're really augmenting the yield that we're getting on our cash.
Awesome. Thanks, Matt. One more question, a good one to finish off. Could you share with us an investment mistake in the fund history and what lessons were learned from that mistake?
Oh, yes. Well, we've made mistakes in the past. We will make mistakes in the future. We try very hard to avoid mistakes. I think Buffett says that 30%, a third of his mistakes are, a third of his investments are errors. So even the best do make these mistakes. So there's one glaring error some of you are familiar with. In fact, many of you were involved with, and that error was with Horsehead. So there were so many lessons learned when we got involved in Horsehead. And why don't I just list off a few? So the scenario was that management was providing false information, in fact, fraudulent information to the public. We ended up pro se motion with Guy Spear. We ended up fighting in the courts in Delaware. In fact, many of you are there. I see Robert right here on the screen. I know many of you throughout that, because of that process, as painful as it was, meeting many of you, like Ed George, who I see here, was a huge highlight. And so what did we learn? We learned that, first of all, as a business, we were relying on a very complex factory to be developed. And that the entire success of the business was dependent on that factory developing appropriately. And that was a huge risk that we didn't really consider, because the engineering was so complicated and it wasn't presented fully to the public that it was very hard to tell where they're recycling steel, this electronic arc furnace dust, and they had all sorts of cathodes and chemistry and things. And very late in the process, the engineers determined that they had built or constructed this wrong. It was going to be too costly to repair. And they did a pre-packaged bankruptcy deal that was orchestrated by some funds, as well as some legal teams and the management. And it was really disruptive. We had a nice, solid position. It publicly looked very undervalued. Privately, they were exploring alternative options. And ultimately, we had received a very small payout. We were validated by the judge. It was truly not a bankrupt entity. However, the cost overruns and things, was ultimately rewarded to the debt holders. And so it's very important to know who the other shareholders are within the business that you're owning. The other shareholders can be an asset, and most firms don't think about it that way. Berkshire Hathaway thinks about it that way very much. They take a lot of care to find and attract the best shareholders because they recognize it's going to be valuable in time. So it's really nice to go into a position and know that there's a high quality, large shareholder who has our similar interests in mind. So if we see that Buffett has a large holding, or Bill Ackman has a large holding, or even Eddie Lampert has a large holding, we know that if we're aligned with their share structure, at least they can maybe be pushing things and we can aid them or assist them to push things in the right direction. We also learn to recognize how dangerous debt is. It's surprising to acknowledge that we weren't recognizing it, but the operating leverage is very real. And we see that playing out in Seritage in real time again today. The small change in the cap rates are causing massive swings in the valuation of the Seritage properties. And it's all affiliated with the operational, with the operational leverage that they're using. One thing that we've noted and added to our checklist as a result of Horsehead is something we failed to do at the time was go and look at the debt instruments, go and look at the publicly traded debt instruments. It's very interesting because a lot of the folks who are trading commercial paper are looking at things in a different manner than those who are holding the equity. But the commercial paper is higher on the capital structure than the equity holders. The equity holders get what's left over after they pay the debt. And so what happens is there are times when equity holders are rallying around some great value opportunity, and you go and look in the publicly traded commercial paper and it's selling at a 40 or 50% discount to par. And that's a huge red flag. So the debt holders oftentimes discover something going wrong that the equity holders have missed. They're higher on the cap structure. They're concerned about getting their par value back. So if something starts trading at a large discount to the par value of the commercial paper, it's a very nice leading indicator that something might be wrong. And those are a few of the things that we learned out of Horsehead. We analyzed we have a very thorough post-mortem analysis that we do on our exited positions. We like them all to work out. Inevitably, some of them do not work out. Thankfully, we avoided that fate with Seritage.
Okay, fantastic. Thanks very much, Matthew. Unfortunately, that's all we have time for today. So with that said, I'd just like to say thank you very much, everybody, for joining us. Thanks for taking a few hours out of your day to hear the latest in the Peterson capital management world. Also just wanted to say a big thank you to Matthew for taking the time to organize this meeting and also for inviting me to be the host today. It's been a really fun experience. It's been a great pleasure to join you all. And with that said, we'll conclude the meeting and I'll just pass over to Matthew for some closing remarks.
Yeah, excellent. And Brandon, thank you so much as well. Your channel is amazing. I'm really pleased to see the success. Thank you all for being here. We are on October 1st going to mark 12 years in this fund. And somehow we still view this as the beginning, but we have made significant progress. We have a substantial track record. I think it proves that the practices we're putting in place are effective and the achievements have been substantial. So if folks on this call are interested in participating, we have our next commitment date on October 1st. Please reach out to myself or Andrew so we can prepare for the new capital coming in. We have a lot of new capital that's coming in all the time now. And the next date after that is January 1st. So October 1st or January 1st are great opportunities for you. And we really like these opportunities to see everybody. I appreciate everyone joining from all over the world, from these various time zones. I see Digby sitting in the dark. We can let him now go to sleep. It's such a pleasure. It's actually a true honor to be with such esteemed individuals. The LP base that we have attracted is extraordinary. Many of you don't know each other. My hope is that over time, we create a community that allows you to interact. It's a very, very special, esteemed group of individuals, and it's a real honor to work with all of you. I really look forward to many decades ahead.